1, 5, 8, 11, 15, 23, 45, 47, 55, 72, 82, $93. So we have earned $93 this year. Huh? No, just from our investments. I'm glad that we invested so much. Next year, if we are very good, if the market will be good, maybe we'll earn $100. Woo! Hi guys, and welcome to the new episode of B-Vibe, where we talk everything related to how to escape the ordinary. So, just to recall ourselves what we have been talking in the past few episodes. So we are talking how to escape the ordinary. We are talking about the matrix, what is the matrix, how to escape it. And the last episodes were about how to budget yourself, how to create a good budget. So we have seen how the world is a very big and complex place. And we have seen some of the mechanisms that you can use in order to escape the matrix. So one of the biggest milestones and steps that you can take in order to escape the matrix is, you know what? So it's financial freedom. That means, in layman terms, that you don't have to care about money anymore. So you have enough to support your lifestyle, whatever it is. Then, in order to become financially free, we have seen that we have to take care of our budgets. So this is the number one that we have to take care. And the last time we have seen what is the formula, what is my formula, my budget, and how I manage my own budget. So if we can recall ourselves, it is your income minus your must expenses. So those are your utility bills, electricity, gas, water, internet, and such things. Then we have investments plus savings plus future, or how do we call it, future expenses. So planned future expenses and personal bank. Okay, so this is the formula of my budget, and you can see that the number one priority is to invest. The second one is to save up to a certain amount. After that, you don't have to save. So if you can recall, it was 3 to 6 months worth of your must expenses. Then your planned future expenses like vacations, birthday gifts, and such things. And then you have your personal bank. Basically, it's our play money, what you can do, whatever you want with that money during the, say, 1 month. The one thing that I maybe didn't mention last time was what is my current situation regarding the budget and how much percentage-wise of my income is used in all of these categories. So you can see when I get my income, when I pay my must expenses, the leftover money, I put it in 4 different categories. For investments, it's around 40% of leftover. For savings, currently it's around 10%. For future expenses, currently is 30%, and around 20% is for my personal bank. So you can see it adds up to 100% of leftover. One big notice for you guys. In case if my expenses are the same as my income, so income minus expenses equals 0, then certainly I will not invest anything because I don't have any money. But in any case, if this is larger than 0, okay, so I have some leftover money, first thing that I will do, as I said it before, I will invest. I will pay myself first. Okay, then I will save up to 3 to 6 months of my must expenses. Then I will put some money into my planned expenses. And the last priority is my personal bank or play money. Go to movies, buying myself some things, shoes, this or that. Okay, so what is the difference if we are talking about the rich mindset and the poor mindset? Rich mindset goes like this. They take their income, whatever it is, minus their must expenses equals investments plus maybe something, okay, maybe some play money or something like that, but investments are the biggest chunk, the biggest percentage of their leftover money goes into investments. And then they reinvest the leftover money into some kind of additional things, and those things for the rich people are assets. Okay, so rich mindset is income minus expenses equal leftover money that goes into assets that will pay them money. So it will go here. The poor mindset is income, if they have any kind of income, minus must expenses equals dumb shit. Okay, guys? So this is why the poor stay poor and the rich became richer, because they use their money as a leverage to buy more time, and with that time they get more skills, more people with more values, etc., more assets that produce something. They produce some different kinds of, I don't know, sellable materials, so they can monetize it like an additional income stream. That's why the rich are getting richer. For the poor, if you have some leftover money, if you take all the money and buy dumb shit, basically you are left with zero, with nothing. This dumb shit will not produce anything, will not be invested in some kind of new business so it will produce. It will not increase, probably it's very likely it will not increase in value over time, so it will only decrease in value over time. Maybe you are able to sell this in 2 or 3 years, but in most of the cases after some time it is worthless garbage, and that's it. So you put your money, your hard-earned money, into something that will lose its value very fast, and you will be left with nothing. And do you understand, when you buy your dumb shit, what happens? Basically, you go to the store, you put your money in the shoes, in your Chanel, in Louis Vuitton bags or something like that. And do you know where that money goes? It goes here. Because businesses are one type of investments for the rich guys. So those businesses are, let's say, selling shoes or bags. And those things from you and me who buy those kind of stupid shit, it goes into business of the rich people, and they pay them in a sense of an income, additional income stream. That's why someone said, if you took all the money from the system and then equally distributed to every person, so you give each person the same amount of money, after some time, all of that money will be somehow directed and will float into the pockets of the rich people. So it will pour into the pockets of them. Why? Why is this like that? Because the rich people, they have skills and they have knowledge how to take the money from you. So they're not aggressive, like they're taking by brute force it from you, because we live in such kind of society. We are consumers. When we buy dumb shit, what it means that we are willingly, by our own will, no one forces us, we are giving our money to the rich people. So, you guys, you understand what is the difference between the rich mindset and the poor mindset. So I will now clean this. Today, we will cover the investments, because the investments is the biggest differentiator between the rich mindset and the poor mindset. So once more, the rich have some leftover money, they pour it into investments. And the poor people, if they have any leftover money, they'll spend on dumb shit. And that's the main difference. If you have enough money, so you can put it into investments, it can pay you out your expenses, your living expenses, and it can support your lifestyle. And then if you're still left over with some money, sure, you can buy yourself a Bugatti, you can buy yourself a yacht, you can go to the Maldives or such things. Because basically you are well covered financially looking with your passive incomes, with your multiple income streams. Okay? So for the investments, for me, it's mandatory that I invest. It should also be for you to invest in yourself, into your future, so that you have, in the long run, at least in the long run, you have some value stored somewhere that can pay you during your working lifetime, during your retirement, and so on. First of all, I would not suggest that you go into investments if you have some kind of debt. Stupid, bad debt. When I say stupid bad debt, it means, let's say, credit card debt. And you should pay that kind of debt very fast. Why? Because that kind of debt, as I said before, it tends to have interest. Let's say you pay interest 10 to 20%. And in investments, if you are going into this kind of world, you will see that if you get on a yearly basis, so annual return 8 to 10%, it's a very, very good investment. It's a very good investment, and it's even better if it's a stable one. So you see why is this a problem? If you start investing and you also having a debt that you have to pay, if your debt is, let's say, 15% interest, and you gain only 10% of interest in your investments, you're still minus 5% down. So first, you should think and focus yourself onto how to close and pay out this debt. Only then, when you are above water, let's say you have some air to breathe, then you should think about how to start investing. Okay, guys? So somebody would say, okay, how the poor guys, in most of the cases, poor people are saying we should tax. So we have the rich, we have the poor. We should tax the rich in a sense that the rich will pay some money, let's say to the government, and the government will pay back in some way and give us money. It's not good. Why? Because if you start to tax first of all, you cannot tax the rich. Then second, if you start taxing heavily the rich, they will try to avoid it. If they cannot avoid it, then it will certainly have an impact on their business. Then they will try to move business to another country where there is less tax. Then maybe you will lose your job because you are working at a company of that rich guy, rich dude. So you understand, those wishes that we should tax the rich have implications on a wider society, including me, including you, because in most of the cases we are in a worker's position and we work for some company, basically for the rich dudes, and our, let's say, bosses are working for even richer dudes, and so on. That's why one of the reasons why it's not good to tax the rich. The second one is the rich guys are the ones who are giving the jobs, who are opening the companies, opening the industries, the factories. You understand? And they are building the society, they are lifting up your GDP and so on. So it's not in anyone's interest to heavily tax the rich, because they are the backbone of the society. They are bringing everything and everyone up. And you should give some kind of tax reliefs to the rich guys, and basically this is what is happening, if they are providing some added value. So let's say they are building something, they are building some real estate and so on. Why? Why the real estate is, let's say in America, is tax deductible? Because you are providing new jobs, new values. That's why you can deduce the tax from your income if you are doing such kind of, let's say, business. So it's an incentive, and the tax shouldn't be looked at as a penalty for someone. It should be looked at as an incentive. It's a guidebook which says, okay, you should do this, this, and this in order to in order to deduce your taxes, in order to have some benefits from your government, etc. If you don't want to do that, if you want to be only a worker in a company, obviously you will be heavily taxed, because you're not providing any additional added value except of working in that company. You're not creating new jobs, you're not building new factories, you're not building some pipelines. You understand me? That's why the worker's paycheck is heavily taxed, and the rich guys, they have incentives to deduce their income taxes if they are going along with the guidelines of the government. Okay? So basically, when we say, and when we are talking about investments, let's say, what are the investments? So the investments, and I will read it because I have written it down. So it's the allocation of resources, usually money, into assets. So investments means putting money, let's say, into assets or ventures with the expectation of generating future income, profit, or value appreciation. So people invest in various kinds of assets like stocks, bonds, real estate, businesses, etc. And the goal is to achieve some kind of wealth, some kind of profit, or to support specific projects. You have to know, when you start investing, there is a certain amount of risk that you are basically taking. So investments generally carry a certain amount of risk. High risk, potentially high reward. The rich understand this game, and obviously they are looking for the things to invest where there is the lowest possible risk with the maximum potential gain. So this is the game. There are not a lot of things, because if you want to have a low risk, in most of the cases you will have a low reward. And then if you go into these higher, let's say, levels of wealth, and then you have millions or billions of dollars, then you don't even care about this kind of games, because you have built your wealth. It's big enough. It's only what you need is to preserve the current amount of wealth that you have. In order to do that, you can find yourself some low risk index or something like that will give you, let's say, 10% or 8% per year annual return. And if you put inside 10 millions and you have 10%, it's 1 million you are paid in interest a year. And that's good enough for you. You're fighting the inflation and you have preserved your wealth. So returns in the investments, they are not guaranteed. I know that most of you would like to have, if I put $50 here, I want to have 150 out. No, it doesn't work that way. And many of you I have seen, especially in crypto, where they're putting inside $100 or $200 or $300, and they say, okay, I want to make from $100, I want to have
$100 billion.
So it's practical. It can happen, of course. It did happen previously. You could bought Bitcoin at this price 13 years ago, and now you would be more than a millionaire. But those are such rare occasions. Those are unicorns, So it's pure luck if you have invested in such things. And basically, especially in crypto, it will not happen again, because we call that stupid money. So the stupid money is pretty much out. There were, I believe, 3 or 4 bull runs till now in crypto industries, and basically this stupid money has been washed out, and now we are getting into a more regulated space where some administrations and some government institutions and also some companies and some big players like BlackRock, etc., they are going into crypto. They are pouring their millions and billions of dollars into it, and pretty much down the road, I expect that the crypto industry will somehow level up, in a sense that it will not have so much oscillations and variations during the day, during the month, and so on, in terms of the price. So you have to realize, with investments, it comes some kind of risk. And you have to realize this risk. You have to pay attention, read the newspapers, read the portals, read the stocks. So you want to read about how the company is doing, what are their profits, what are their losses, how many employees they have, in what type of, let's say, product will they invest in the next year, what is their competition, how are they doing, and so on. So you have to keep track of all of those things. Why? Because in that way you are basically lowering your risk. So many will say, okay, putting money in stocks, it's like gambling. Yeah, it's like gambling if you don't read anything. If you just go into your applications and then put $100 on some Coca-Cola stock, and you don't read anything, you don't pay attention to the markets, what's going on in the world, what's going on in the business, of course, then it's gambling. But if you're reading, if you're paying attention, basically if you buy a stock, you buy a share in the company, you have to know who are the executives, who are the CEOs, the CTOs, who is the upper management. what they are doing the next year, what are their plans, how did they do this year, and was it better than the year before. So you have to track these things. And if you track and if you contemplate on that things, then this risk goes down. And then that's not a pure guess. Then it's a, let's say, well-defined decision. You can have different kinds of rewards in terms of, let's say, dividends, let's say maybe some rental income. I mean, in case you have some kind of real estate, then you want to rent it out, then you have rental income, then you have maybe some capital gains. So this is the game. So the investments are things where you put your money in some kind of assets, and assets are things that can preserve value and they can produce something even better. So some assets can only preserve value, but some assets can also produce something. So basically, if you put some money into some kind of industry, into some kind of company, and that company produces something, like a farm, something like that, then that assets, that company as an asset, it produces something, it can produce even more next year, and it can sell more, and it can preserve the value, so the value of the company can stay the same, or even it can go up. Also, it can go down. If they have a bad year, if they don't sell as much as they have planned, and so on. That's why you have to track. Then you have to realize what is the markets. So everything in this world basically is selling. That is how the value exchanges between two people, by selling. You have one person, you have another person. This person wants something. He wants, let's say, a product A, and this person is selling. So this is a buyer, and he wants thing A, and this is a producer. Seller, let's say, seller doesn't have to produce, but he has this kind of product by his side, and he can sell, let's say, A, B, C. So this person is asking, do you have A? Or this person is selling to this person saying, okay, do you want to buy A? And everything in your life, in the history of mankind, is basically this. It's selling and buying. And depends on how much buyers you have and how much sellers you have, the price go up or down. It is called market. So it's the place where the interchange of this value is performed, conducted. And it's driven by two things: demand and supply. So you have the people that want something, and you have people that provides something. Obviously, if you have a higher demand and limited supply, so you have, I don't know, 1,000 bottles of juice, and you have 3,000 people that want to drink juice and buy a bottle of juice, then the price will go up, because the sellers will obviously see there is a high demand for this product and that they can earn more. Why should they sell it for $3 a bottle if they can sell it for $5? Because there are people waiting in line, and there are some people that are willing to pay the VIP price. Why not? And you have the other way around. When the supply is much greater than demand, you have a lot of this product and basically less people that want to buy, or even none. So no one wants to buy. In that case, what you can do only is to lower the price until you have met some buyers that are willing to buy at this lower price. And basically, that is it. That's the markets. Investments are also all about this. So you are putting your money into assets, but what kind of assets? So this is the game. Investments are basically the steps you take to buy the assets which are high in demand, so high demand and low supply. It means what you want is to buy something that it's scarce, you don't have it a lot around you, and there is a lot of people that are trying to buy that thing, or they will try to buy that thing in the future. So it's a game. Let's say you have an apartment, and you have an apartment in a nice neighborhood, and you see that there is a lot of people that are coming to this neighborhood, and there are only a few of apartment buildings for rent or few apartment buildings to buy. And basically what will happen, you have a priority, so the guys with the most money, they will buy it for a premium price because they want to live in that neighborhood, they want to buy and have this apartment before anyone else. And that's why you're buying assets. You always have to think and ask yourself, are these assets in high demand or not? Do the assets have enough supply or not? So it has to be scarce. You're looking for this kind of assets. Let's see some of the investments where you can put your money. It depends, first of all, how much money you have now. Because, as I already said, if you have a lot of money, then you are starting your investment path with putting your money into something that has a low risk. It will give you some continuous recurring income, recurring interest, and you will be satisfied with that. And you don't need some very extraordinary interest and high risk things. In case when you are in a position like me and you want to start invest and you don't have a lot of money invested already, or you want to start invested for the first time, you have some extra money, what should you do? The only thing that you can do is to influence and have impact on your income and have impact on your expenses. What does it mean? It means you can increase the money that goes into your pockets and you can decrease the money that goes out in terms of your must expenses. You can revise the list and say, okay, I need this, I don't need that, maybe I don't need some kind of subscription, because subscription on, let's say, Netflix or any kind of subscription certainly is not a must expense. For income, how you can increase your income? By adding additional jobs. Let's say additional jobs, side hustles, and so on. Obviously, it will increase your income. How will you get these jobs and hustles? You can employ your own skills that you have now, so you can put in those skills to work. Or the first investment that you can do is to invest in your skills. What does it mean? It means that you buy something, maybe some tutorial, maybe some book, maybe some online materials, learning materials, in order to gain more skills that you can put to work, that will give you another job, that will give you additional income. So simple as that. And for the first part of your investment, you should focus on increasing your skills and increasing your active income. Active income means that you are trading your time for money. So you are working additional 2 or 3 hours a day to get some additional income. Okay? After that, once you have put your skills to work, next thing that you can invest into is to your business, your own business. So you should think about what are you good at. Maybe you can give or provide some kind of skills of some kind of added value. So it has to be an added value. It's great when you talk to the people and if you are showing them what you can do that if they cannot do it by themselves and they say, oh, you should make something or you should make some kind of product, you should sell that. Why not? Because if there is a demand for that and the supply is low, obviously you will be able to monetize your own business, you will be able to create added new value, and you will be able to create yourself additional income streams. My suggestion is, if you have a standard 9-to-5 job, is that you retain your job, you work in parallel on your skills and your own businesses until this business and your additional income streams provide you, let's say, times 2 or times 3 the amount of money that you are getting with your paycheck today. So let's say if you're getting with your paycheck is, let's say, $1,000, you shouldn't, it's my philosophy, you shouldn't leave your job unless your additional income streams are giving you constantly and predictably, easily, so it's easily to predict that you will get it in the next month, let's say at least $2,000 to $3,000. So once you get to this level and you have $3,000 each month, or let's say 5 to 6 months, then maybe it's time to say bye-bye to your old job.
Yes!
And start working more and more on your own business and start more and more monetizing your skills. Why? Because in some certain point of time, in order to become bigger, to get even more money, you will have to scale up your own business. That means you will have to trade even more of your time and devote that time to your business in order to get to this kind of levels, or to, let's say, $15,000. You will have to work and you have to work more and you have to focus yourself more on that specific kind of business. That's why you will not be able to do it with having your old job in parallel. But it's a normal path during your escape the ordinary road, to escape the matrix, to do it like this. So those are the two obvious things where you can invest. So the first thing when you start investing is to invest in yourself, in your brain, in your mind, in your skills, in your abilities, in order to give more added value to the society. And also one tip, you should fail fast if it doesn't work. So if you want to do and create your own business, you should test it. Don't create everything around your business, employ a lot of workers, buy yourself a working space or something like that, an office. Before you test your idea, before you put it, it's called MVP, minimal viable product, you put it to the market and then you test it and see if the market is responding well to it, if there is enough demand for that kind of product and you are able to produce it in a timely manner. That's why you have to test it before you start all the shebang around your own business. Okay, I believe this is pretty much clear. And guys, if you want to learn more about certain topics that we are covering in this podcast, like how to do affiliate marketing, how to do trading, crypto, forex, finance, general finance, and you want to learn more about how to escape the ordinary, how to escape this matrix pit and know the information that I am personally learning, then you have a possibility to enroll and to find out more in this game changer application. So the application is also available through the link that is available on my personal page. So you have a link here in the descriptions that you can go and check by yourself.